This next lecture will simply provide a summary of Chapter 14. The statement of cash flows explains why the cash balance does not equal net income or loss from the income statement. Cash on the statement of cash flows includes cash equivalents. Cash equivalents are assets so close to being cash that they are treated like cash. The statement helps users predict future cash flows, evaluate management decisions, and predict the company's ability to pay debts and dividends. Operating activities reflect the day-to-day business operations. They affect current assets and current liabilities. Investing activities report the purchase and sales of long-term assets, such as building and long-term non-trade loans receivable. Financing activities reflect the capitalization of the business and include increases and decreases in long-term liability and equity accounts, paying dividends, and treasury stock transactions. Only the operating activities section is presented differently between the indirect and the direct methods. The indirect cash flow statement begins with operating activities. Net income or net loss from the income statement is the first item listed. Then adjustments are made based on changes in current asset and current liability accounts to derive cash provided by or used for operating activities. Then investing activities are reported, showing cash used to purchase or cash received from selling long-term assets. Finally, financing activities are reported, showing the cash used to pay long-term liabilities, to pay cash dividends, or to purchase treasury shares, and cash received from issuing new long-term liabilities or issuing stock. The total of the cash flows from the three activities, operating, investing, and financing, equals the change in cash balance. Companies make investments that do not require cash. They also obtain financing other than cash. Such transactions are called non-cash investing and financing activities and appear in a separate part of the statement of cash flow. Free cash flow measures the free cash flow measures the amount of cash available from normal operations after paying for planned investments in long-term assets and after paying cash dividends to shareholders. In Appendix 14A, we learn that the Financial Accounting Standards Board, or FASB, prefers the direct method of reporting cash flows from operating activities. The direct method provides clearer information about the sources and uses of cash than does the indirect method. In Appendix 14B, we see that the T-account approach works well as a learning device. In practice, however, most companies face complex situations. In these cases, a spreadsheet can help and prepare the statement of cash flows.